Hi everybody, in this video I'm going to show you the difference between buy call and sell put and which is better for generating income if you are an option trader. Hey, this is Lili and I'm a Kashikoi Trader and I trade in stock options as the ROI compared to other form of investment is way higher. To me, options trading is really powerful if you know what strategy to use for what type of stocks to generate income. As an option trader, I also provide options training to anyone, especially for those who want to generate income on the side, as they may not have the time to monitor the market. For this video, I will use Microsoft stock as it is a good business. And if you can see the stock chart, over the past 5 years, it is trending up. And like any other stock, although it may fluctuate up and down, generally the trend is on an uptrend. And if you zoom in, you realize that the highs are getting higher and the lows are getting higher as well. And in options trading, when the stock is trending up, generally we can either buy a call or sell a put. Now let's look at buy call. January 19, Microsoft last traded is 216. And we do a buy call with date to expiry 150 days for the contract, which is 16th of June 2021. We'll select a strike price of 215 and pay a premium of 1670, which is actually equals to 1007 because one contract is 100 shares. So 1006 is now our initial capital. Let's fast forward to February the 3rd. And when the price moves up to near resistance, so we'll close the position by selling the contract back. And we collect a premium of 3.5K. So our profit in terms of dollar and cents would be 1.9K or an ROI of 113.5% because our initial capital is only 1.6. If we had chosen to sell put instead on January the 19th, last traded 216. For sell put, basically in options, right, we choose a shorter expiry date. If you want to know why the difference, please watch my past video on the extrinsic value. That is time decay, how it plays against or in your favor, depending on the position you take. So again, back to here, strike price 215 for sell put. And when I sell, I collect a premium of $652. Fast forward to February the 19th, when the price actually closed above our strike price of 215, that is 240 above 215, the contract, this sell put contract actually expired worthless, meaning to say it has no more value. Therefore, I, as a seller of the put option, gets to keep the premium. So my ROI would be 3.03. It is low, you can see it, because of the amount that I am supposedly committed in this position. Because if the stock was assigned to me, should the price drop below 215 strike price, I'm expected to acquire this stock at the agreed strike price, which is actually 21,500 for 100 shares. Therefore, this is the way it's calculated. But if you look at 3.03% for around 1 month of trade, over 12 months is actually not too bad. 12 times 3 is about 36% a year. Compared to the bank interest, it's around 0.05, right? So this is way above what a bank can offer you. Now let's move forward to March the 5th, when the stock price drops down to near the support again, and we enter a buy call position. So the last transacted is 231, and we select again the next expiry, which is 133 days or 16th of June. Extract price 230, and we pay a premium of 1.7K. So fast forward to April the 15th, when the stock is near the resistance, the stock price, we close the position and we collect a premium of 3.2K. So my profit is 1.4K or an ROI of 81.7%. Again, using my initial capital of 1.6 from the January transaction and this March transaction, my total profit in terms of dollar and cents would be 3.3K or an ROI of 201% from my initial capital of 1.6K. If I had sold a put instead on March 5th, last transacted is 231.60, short DTE of 27 days, that is expiring on 1st April. Strike price 230, I collect a premium of 613. So fast forward to 1st of April again, the stock actually moves up and above my strike price of 230. Therefore, again, I get to keep my premium of 613, which is a total ROI of 2.07. So from the January sell put position and this March sell put position, my total profit for these two are 1.3K. Let's move forward to May the 13th. And again, let's do a buy call. So last transacted, 243. And we choose a date to expiry of 1 to 7 days, which is expiry on 17th of September. Strike price 240, and we pay a premium of 16.83. But because of the January and March transaction, we had a total profit of around 3.3K plus our initial capital of 1.6K. Total, I have around 4.7K. So I can afford to buy 2 call contracts now. So I paid 3.3K for 2 contracts. Fast forward to July the 13th, that is around 2 months later, when the stock price has risen to near the resistance. I close the position again and I collect $42 per share. Therefore, my profit would be 5K. And total ROI is 149.6% for my 2 months trade. And based on my initial capital of 1.6K, my total profit is around 8.4K or a whopping total ROI of 502%. Wow, can't you see that it's really, really powerful? Now, if I were to sell put for May 13 instead of buy call, now let's look at it. You see that I can collect a premium of $612, okay, with date to expiry of 29 days. So fast forward to June 11th, because June 11th would be the date to expiry, right? Again, the contract expired worthless because it has closed above the strike price of 242.50 cents. Therefore, I get to keep the premium of 612. My ROI is only 2.05% because of the way it's calculated. So from my 3 sell put positions, January, March, and May, closing June 11th, I only make about 1.9K. Now, let's compare the two. Which is really better? Is it buy call? Initial capital of 1.6K. My total ROI is actually 502% or a whopping 8.4K dollars, or sell put, which is a profit of 1.9K. for around 6 months. Okay, the ROI is around 2 to 3% for each contract. Well, it really depends on what is your objective. If your objective is to own a good business at a discount, then it is better if you can sell the put position because you can get the discount, meaning to say when you sell the put, you collect premium upfront while you wait for the stock to drop down to your strike price, which is usually the fair value price that you think the stock price is worth. But if your objective, like mine, is to collect good premium actually, then you may want to consider buying call instead of selling put because you can see from what I presented earlier, over a course of about 7 months, my profit was around 8.4K. And if you were to do a buy call position, basically if the stock price has increased and is more than the premium that you paid plus a strike price, as a buy call option trader, you can actually exercise your right to purchase the stock at the strike price if this scenario presents itself to you. And you still can own 100 shares at the agreed strike price. I hope you have actually gained much knowledge from this. And if you like what I've shared, please like it and subscribe to my channel. And I'll see you in the next video.